Imagine this. You work hard your entire life. You save carefully, every single month. You put your money in the bank. You play it safe. And then, 40 years later, you retire. You open your account. The money is all there. Every dollar. Exactly as you saved it. But something is terribly wrong. The money that could buy you a house in 1990 can barely buy a car today. The money that fed a family for a month in 2000 lasts 1 week today. Your savings did not save you. This is the story of inflation. This is what happens when you understand money, but not deeply enough. In part 1, we covered where money came from. Today, in part 2, we are going to talk about what money is right now, and what it is silently doing to everything you have worked for. Welcome back to Wealth Prowler. This is part 2 of our very first topic of what is money. If you have not watched part 1 yet, please stop right now and watch that first. The link is in the description below. Part 1 covers the complete history of money, from the barter system to gold to paper money. It will make this video 10 times more powerful. For those who have watched part 1, a very quick recap. We learned that money is a tool with 3 jobs: medium of exchange, store of value, and unit of account. We learned how barter failed, how gold became global currency, how paper money was born from goldsmith receipts. And we ended in 1971, when the United States broke the link between the dollar and gold. That moment changed everything. And understanding what happened after 1971 is what today is all about. In this video, part 2, here is exactly what we are going to cover. 1. What is fiat money, the money we use today, and why it has value without gold? 2. What is the money market, and what does it mean when money has a price? 3. What is inflation, how it works, and why it is stealing from you right now? 4. What happens when inflation goes completely out of control, the scary truth? 5. And most importantly, what you should do about all of this. By the end of this video, you will understand money more deeply than most of people. Let us begin. So what happened after 1971? When Nixon ended the gold standard, the world moved to what we call fiat money. And this is the money that exists in your wallet right now. The word fiat comes from Latin. It means by decree, by official order, by authority. Fiat money is money that has value, not because gold backs it, but because the government says it has value, and because all of us agree that it has value. Think about this very carefully. Take any currency note, a $100 note, a $10 bill. What is it physically? It is a piece of paper, cotton and ink. It costs less than $1 to print. But everyone accepts it, everyone uses it, everyone trusts it. Why? Because of one thing: trust. We trust the government that issued it. We trust that tomorrow, the person we buy from will accept this note. We trust that the system will keep working. Money is, at its deepest level, a shared agreement between human beings. A collective belief that this piece of paper has value. And the moment people stop believing, money collapses. We will see a terrifying example of that later in this video. Now, fiat money is not a bad idea. It actually has real advantages. Advantage 1. Flexibility. Governments can create more money when the economy needs it. During COVID in 2020, governments around the world were able to send money directly to people within weeks. Under the gold standard, this would have been impossible. There simply was not enough gold. Advantage 2. Economic management. Central banks, like the US Federal Reserve, can adjust the money supply. They can fight recessions. They can slow down an overheating economy. They have tools to manage the economy that simply did not exist under the gold standard. So fiat money is not evil. It is a tool. But like any powerful tool, in the wrong hands, it becomes dangerous. And there is one specific danger that affects every single one of us, every day. It is called inflation. But before we get there, let me explain something from our research that most people never think about. Here is something fascinating. We talk about the price of apples, the price of a house, the price of a car. But did you know, money itself has a price? This is one of the most confusing ideas in finance, but it becomes simple when you understand it. The price of money is called interest. Let me give you a simple example. Imagine you need $10,000, but you do not have it right now. You go to a bank. The bank lends you $10,000 today, but in 1 year, you have to pay back $10,500. That extra $500, that is the price you paid for using money that was not yours. That is interest. That is the price of money. Now, where does this happen at a massive scale? In what is called the money market. The money market is not a physical place. It is the global system where governments, banks, and institutions borrow and lend money from each other. Every single day, trillions of dollars are exchanged in the money market. When you hear on the news that interest rates went up or down, that is the money market at work. When the Federal Bank of America raises its repo rate, it is changing the price of money. When the U.S. Federal Reserve cuts rates, it is making money cheaper to borrow. Why does this matter for you? Because the price of money, interest rates, affects everything. Your home loan, your car loan, your fixed deposit, your savings account, the stock market, real estate prices, business growth, all of it is connected to one thing, the price of money. And the price of money is directly connected to the biggest concept we are about to discuss, inflation. I want you to think of inflation as a thief. But unlike a normal thief, this one does not break into your house. This one does not steal your phone or your wallet. This thief is invisible. This thief works slowly, silently, every single day. And by the time you realize what happened, it is too late. Let me define inflation in the simplest possible way. Inflation is the general rise in prices over time. Or, said another way, inflation is the decrease in what your money can buy. Let me give you 3 real examples that will make this crystal clear. In America, in the year 2000, a cup of tea at a roadside stall cost about $2. Today, in 2026, that same cup of tea costs $20 to $25. The tea did not change. The water did not change. The cup did not change. But the price went up 10 to 12 times. Why? Because each dollar is worth less than it used to be. What $2 could buy in 2000 now requires $20. That is inflation at work. Now here is where it gets personal, and I want you to really sit with this. Imagine your grandfather saved $1 million in the year 2000. He kept it carefully, in a low-interest savings account, or maybe at home. He was responsible. He was disciplined. Today, 26 years later, he still has $1 million. Same number, same notes. But can he buy the same things he could in 2000? Absolutely not. What cost $1 million in 2000 now costs $8 to $15 million. His purchasing power dropped by 80 to 90%. Even though he never spent a single dollar, he saved perfectly, and inflation still took almost everything. This is the savings trap, and hundreds of millions of people around the world fall into it every generation. Here are the real numbers. The United States has averaged around 2 to 3% inflation every year. Most developing countries see 5 to 10%. Some countries have experienced even more. At 6% inflation per year, here is what happens to your money. In 12 years, your purchasing power is cut in half. In 24 years, it is cut to 1/4. In 36 years, it is worth only 12% of what it was. There is a simple rule called the Rule of 72. Let that sink in. If this video is giving you value, please hit the like button right now. It takes 1 second, and it genuinely helps this channel reach more people. People who need this knowledge just as much as you did. Now let us continue, because the next part is absolutely critical. Normal inflation, 5 or 6% per year, is uncomfortable. But there is a far more extreme version, and it has happened in real countries. In recent history, it is called hyperinflation. Hyperinflation is when prices rise not by 5% per year, but by thousands of percent, or millions, or even billions, in days, not years. After World War I, Germany was buried in debt from war reparations. The government made one catastrophic decision. They printed money, massive amounts of money, to pay their debts. By November 1923, $1 was equal to 4.2 trillion German marks. Prices were doubling every 3 to 4 days. A loaf of bread that cost 250 marks in January 1923 cost 200 billion marks by November. People went shopping with wheelbarrows full of cash, not because they were rich, but because you needed that many notes to buy groceries. Workers were paid twice a day, because by the afternoon, the morning wages had already lost half their value. Trust in the currency had completely collapsed, and with it, the savings of millions of ordinary German families were wiped out entirely. In Zimbabwe in 2008, inflation reached an almost unimaginable level. Economists estimated it at 89.7 sextillion% annually. That is 89.7 followed by 21 zeros. The government printed a $100 trillion note, and that note could barely buy a bus ticket. People abandoned their own currency entirely. They started using US dollars and South African rand instead. The Zimbabwean dollar became worthless paper overnight. Decades of savings, gone, completely. In Venezuela in 2018, inflation exceeded 1 million% per year. Families who had worked their entire lives, who had saved carefully and responsibly, watched everything disappear. Not slowly, in months. A lifetime of savings, erased. These are not ancient history stories. These happened in living memory, in countries not so different from yours. And the cause in every single case was the same. Governments printing too much money, destroying trust, and the currency collapsing under its own weight. Money is trust. When trust dies, money dies with it. Okay, let us take a breath. I have just shown you something uncomfortable. Inflation silently reduces your purchasing power every single year. Hyperinflation can destroy it entirely. Saving alone is not enough. So what do? The answer is one word: invest. But not random investing, smart investing. Your money must grow faster than inflation. If inflation is taking 6% every year, your money needs to earn more than 6% every year. Otherwise, in real terms, you are getting poorer, even as the number in your account goes up. Let me show you something that will change how you think about money forever. Imagine you invest $1,000 every month, starting at age 25, with an average annual return of 12%, which is achievable through stock market index funds over the long term. By the time you are 55, 30 years later, you will have accumulated over $3.5 million. But you only put in $360,000 over those 30 years. The rest, over $3 million, came from compound growth, from your money making more money. Now, if instead you kept that same $1,000 every month in a savings account at 3% interest, after 30 years, you would have around $580,000. Same person, same $1,000 per month, same 30 years. Investing, $3.5 million. Savings account, $580,000. That difference, nearly $3 million, is the price of not understanding money. Albert Einstein reportedly called compound interest the eighth wonder of the world. Those who understand it, earn it. Those who do not, pay it. Now I know what you are thinking. How do I invest? What is the stock market? What are mutual funds? What is SIP? And that is exactly what this channel is here to teach you, step by step, in simple way, from basic. We are going to cover all of it, topic by topic, every single week. Let us bring both part 1 and part 2 together in one complete picture. What money is and how it works. From part 1, money is a tool with 3 jobs: medium of exchange, store of value, and unit of account. Before money, the barter system existed. It failed because of the double coincidence of wants. Commodity money, shells, salt, cattle, gave way to gold, which was durable, rare, portable, divisible, and universal. Governments stamped coins, creating standardized, trusted currency. Trade exploded. Paper money was born from goldsmith receipts. The gold standard tied every note to real gold. In 1971, the gold standard officially ended. From Part 2, we move to fiat money, backed only by government authority and collective trust. The money market is where money is borrowed and lent, and interest is the price of money. Inflation silently reduces the value of your money every year, around 2. This is the complete story of money. From ancient barter to digital wallets, from gold coins to fiat currency, from savings accounts to compound growth. Now you understand money more deeply than most people. The topic of what is money is now complete. Both parts done, foundation built. Now, in our next video, we are going to talk about inflation specifically. It is one of the most important videos we will make on this channel. You will not want to miss it. If this two-part series added value to you, please like this video, subscribe this channel. Drop a comment below that what was the biggest thing you learned from both parts. I read every single comment. Share this video with someone who needs this knowledge. We will meet again very soon on the next topic. Until then, keep learning, keep growing. Bye-bye. See you soon.